As you move deeper into the world of real estate finance, you can now connect three big ideas you have already studied. In earlier chapters, you learned how to estimate a property's value so you could understand what it is reasonably worth in the marketplace. In the prior sections of this chapter, you saw how a mortgage is structured, how applications are received, and how underwriters evaluate risk. This section brings those threads together and focuses on a key practical question: who actually qualifies for a mortgage loan, and on what terms? For most buyers, qualifying for a mortgage is the make or break step between dreaming about homeownership and holding the keys. As a real estate salesperson, you are often the person they turn to for an explanation. When the lender asks for more documents, quotes them a maximum purchase price, or says no to a particular loan program, you do not approve loans, but your ability to explain mortgages, qualification standards, and the surrounding consumer protection rules will give your clients confidence and help keep transactions on track. Understanding the mortgage itself. Before looking at qualification, it helps to revisit what a mortgage actually is. A mortgage is both a loan and a legal contract used to finance the purchase of a home. The lender provides funds to buy the property, and in return, the borrower gives the lender a legal interest in that property as collateral. If the borrower fails to make the required payments, the lender may enforce its rights through foreclosure, taking back and selling the property to recover the unpaid debt. For the borrower, the goal is to avoid foreclosure by repaying the mortgage as agreed, typically through monthly installments. These payments usually include several components rolled into one amount. The principal is the portion of the payment that reduces the outstanding loan balance. The interest is the charge the lender earns for allowing the borrower to use its money. In addition to principal and interest, many borrowers also pay property taxes and homeowners insurance through their monthly mortgage payment. The lender collects these amounts in an escrow account and then pays the tax bill and insurance premiums when due. If the borrower makes a small down payment, the monthly payment may also include private mortgage insurance. This is an extra cost charged when the loan-to-value ratio is high, designed to protect the lender in case of default. While the borrower pays the premium, its purpose is to reduce lender risk on loans with little equity. Together, these items are often referred to in practice as PITI: principal, interest, taxes, and insurance, with mortgage insurance added where applicable. The mortgage also has a term, which is the length of time allowed to repay the loan in full. Common terms are 10, 15, or 30 years. A shorter term usually comes with a lower interest rate but higher monthly payments, while a longer term stretches out repayment and lowers the monthly cost at the price of more total interest over time. This is why many first-time buyers choose a 30-year term. They are focused on managing monthly cash flow, even if it means paying more interest over the life of the loan. Behind the scenes, the way principal and interest are allocated in each payment is governed by an amortization schedule. In the early years, most of each payment goes toward interest and only a small portion to principal reduction. Gradually, as the balance falls, the interest portion shrinks and more of each payment is applied to principal. Lenders can provide amortization tables, so borrowers can see how their balance will change over time. As an agent, you do not need to calculate these tables by hand, but you should be able to explain why clients feel like their loan balance is decreasing slowly in the early years and faster later on. The purpose of a mortgage for borrowers and lenders. From the borrower's point of view, the main purpose of a mortgage is to make home ownership and long-term control of housing possible without waiting decades to save the full purchase price in cash. A well-structured mortgage allows a household with a stable income and reasonable credit history to convert future earnings into a home today. Mortgages can also be used to fund renovations, additions, or major repairs, allowing owners to improve and upgrade their homes over time. From the lender's point of view, a mortgage is an investment. The lender provides capital and earns a return through interest, fees, and, when applicable, servicing income. The property itself serves as collateral, giving the lender a legal safety net if the borrower does not pay. The entire qualification process you are about to study exists because lenders must balance the desire to make loans and earn income with the need to control the risk of loss. Legal and regulatory framework, ECOA, and ability to repay. Modern mortgage lending operates within a detailed framework of federal consumer protection laws. These laws are designed to ensure that borrowers are treated fairly and that lenders make responsible decisions based on real ability to repay, not just on aggressive sales or short-term profit. One of the most important laws is the Equal Credit Opportunity Act, often referred to as ECOA. ECOA requires lenders to evaluate each loan applicant based on that person's own income and credit profile, unless the applicant specifically asks to include another person's income and credit, such as a spouse or co-borrower. The core idea is fairness. A lender may not approve or deny a mortgage based on factors such as race, color, religion, national origin, sex, marital status, age, or the applicant's receipt of public assistance. Instead, the decision must be grounded in legitimate financial criteria: income, debts, credit history, and the property itself. If a lender denies a loan or approves it only under different terms than the applicant requested, ECOA requires that the lender provide a written notice explaining the specific reasons. This gives the applicant an opportunity to understand what went wrong, and in some cases, to correct errors or improve their financial profile for a future application. Another key concept is the ability to repay requirement. Under rules implemented and enforced by the Consumer Financial Protection Bureau, lenders must make a reasonable and good faith determination that a borrower has the ability to repay the loan according to its terms. To do this, they look at several categories of information, including income, employment, expected future earnings, monthly debts, the mortgage payment itself, and other financial obligations. Importantly, lenders may not base their judgment on a temporarily low introductory interest rate for an adjustable rate mortgage. Instead, they must consider the highest rate the borrower might reasonably have to pay under the terms of the loan. In some situations, the rules are more flexible, particularly when a borrower is refinancing from a riskier loan product, such as an interest-only or negatively amortizing loan, into a more stable fixed-rate mortgage. The policy goal is to encourage moves that reduce risk for both borrower and lender. Qualified mortgages and legal protections for lenders. To provide clearer guidelines and more stability in the mortgage market, regulators created the concept of a qualified mortgage. A qualified mortgage is a loan that meets the ability to repay requirements and also includes certain required features, while excluding certain risky features. For example, qualified mortgages cannot have negative amortization, cannot include certain types of balloon payments under most circumstances, and must generally limit points and fees to a set percentage of the loan amount. If a lender issues a qualified mortgage, it receives certain legal protections. In the event of a dispute, the lender can more easily demonstrate that it followed the ability to repay rules. Many common loans meet the qualified mortgage criteria, including most that can be purchased by Fannie Mae or Freddie Mac, or insured or guaranteed by federal agencies, such as the Federal Housing Administration, the Department of Agriculture, or the Department of Veterans Affairs. Even if the borrower's debt ratio is somewhat higher than the standard 43% benchmark. For you as a salesperson, the main takeaway is that most mainstream mortgage products offered by reputable lenders are structured as qualified mortgages, which tend to be safer and more carefully underwritten. Valuations, appraisals, and disclosure to applicants. Before issuing a first lien mortgage on a dwelling, a lender must obtain a written valuation of the property, typically in the form of an appraisal prepared by a licensed or certified appraiser. This connects directly back to your earlier chapters on market value and appraisal methods. The lender uses the appraised value in calculating the loan-to-value ratio and in deciding whether the property provides adequate collateral for the proposed loan amount. Federal rules require creditors to provide applicants with free copies of all appraisals and written valuations developed in connection with a first lien application. The lender must notify applicants in writing that they will receive these copies promptly. Typically, the copies are provided well before closing so that the borrower has a chance to review the valuation. In some cases, if the borrower agrees, the lender may provide the copies at closing, but the borrower cannot be charged extra for the copies themselves. The lender may charge a reasonable fee to obtain or order the appraisal, but not for providing the copy. This disclosure requirement promotes transparency. If the borrower believes the valuation is inaccurate, they can discuss it with the lender, ask for a reconsideration with additional comparable sales, or in some cases, renegotiate the contract or financing terms. High-cost loans and additional consumer protections. Not all mortgages are priced the same. Some loans carry very high interest rates or unusually high points and fees. When the annual percentage rate or total fees exceed certain regulatory thresholds, the loan is considered a high-cost mortgage and additional consumer protections apply. For high-cost mortgages, lenders must provide special advanced disclosures that explain the costs, terms, and associated risks in clear language. In many cases, borrowers must receive counseling from a housing counselor who certifies that the borrower has been informed about the nature of the high-cost mortgage before the loan can be finalized. Regulations also limit the kinds of fees and charges that can be rolled into high-cost loans and restrict practices such as certain prepayment penalties or packed products that add cost without real benefit. As a real estate professional, you are not expected to memorize every threshold, but you should recognize that when a loan looks unusually expensive, your client may be entering high-cost territory that triggers special protections and should be approached with caution. Income qualification, ratios, and capacity to pay. Beyond legal protections, lenders still need practical tools to gauge whether borrowers can handle the payment. Two of the most important tools are the income ratio and the debt ratio. These ratios translate income and obligations into clear numbers the underwriter can compare to guidelines. The income ratio, sometimes called the housing expense ratio, limits what portion of gross monthly income can be spent on housing costs. For this purpose, housing costs usually include principal and interest on the proposed mortgage, property taxes, homeowners insurance, and, when applicable, mortgage insurance and association dues. Many conventional lenders use income ratio guidelines in the range of 25 to 28%. Meaning that the total housing payment should not exceed about a quarter of the borrower's gross income. Certain government-backed loans allow somewhat higher housing ratios. For example, FHA permits housing ratios up to 31%. To find the maximum allowable housing expense under a particular income ratio, the lender multiplies the borrower's gross monthly income by the allowed percentage. Imagine a borrower with gross income of $4,000 per month and a maximum housing ratio of 28%. The maximum monthly housing expense would be $1,120. That figure must cover principal, interest, taxes, and insurance together. The debt ratio, sometimes called the housing plus debt ratio or back-end ratio, adds in the borrower's other monthly obligations. In addition to the proposed housing payment, it includes minimum payments on credit cards, car loans, student loans, installment contracts, and certain other recurring debts. Conventional lenders commonly use a debt ratio guideline around 36%, meaning housing plus other debts together should not exceed 36% of gross monthly income. FHA often permits debt ratios up to 43%. NVA uses a 41% guideline combined with a separate residual income test. Using the same borrower with $4,000 per month in income and a 36% debt ratio, the total allowed housing and debt obligations would be $1,440. If the proposed housing payment is $1,100 and the borrower has another $350 in monthly debts, the total would be $1,450, just over the guideline. In that case, the borrower might need a slightly smaller mortgage or might have to pay off a small debt to bring the ratios back within range. In all cases, these ratios are guidelines, not absolute guarantees of approval or denial. Underwriters also consider the overall profile. A borrower with strong credit scores, large cash reserves, and stable employment may be approved with slightly higher ratios, while a borderline file may be held to stricter standards. Income stability, cash, and net worth ratios alone do not tell the whole story. Lenders also look at the stability and quality of income. A long history in the same occupation, consistent earnings, and clear documentation are viewed more favorably than frequent job changes, gaps in employment, or highly variable income that is difficult to verify. Self-employed borrowers and those with commission-based income often face extra documentation requirements, such as multiple years of tax returns and business records, so that the lender can average earnings and assess sustainability. Cash qualification focuses on whether the borrower has enough funds not only for the down payment, but also for closing costs, and in some cases, reserves. Lenders verify bank balances, investment accounts, and other sources of funds. If part of the down payment is a gift from a relative, the lender will usually require a gift letter confirming that the funds are truly a gift and do not need to be repaid. If the money is borrowed instead, it is treated as another debt and added into the debt ratio, which can reduce the maximum loan amount. Net worth gives the lender a broader view of the borrower's financial strength. A borrower who has assets well in excess of liabilities has a cushion to fall back on if income temporarily drops. This can make the lender more comfortable with approving the loan, especially if some aspects of the file are borderline. Credit evaluation and the role of credit scores. No modern qualification process is complete without a review of the borrower's credit history. Lenders obtain a written credit report from one or more national credit bureaus for every completed application. The report shows open and closed accounts, balances, payment history, public records such as judgments or bankruptcies, and recent inquiries. If the report reveals serious problems, such as repeated late payments, collections, or recent bankruptcies, the lender may deny the application unless there is a strong explanation and evidence that the issues were temporary and have been resolved. If a loan is denied based on information in a credit report, the lender must notify the applicant and advise them of their right to obtain information about the negative findings. Credit scoring adds a numerical summary to the credit report. Using large statistical models, the scoring system assigns a number intended to reflect the likelihood of default. Higher scores indicate lower risk. Secondary market investors, including major entities such as Fannie Mae and Freddie Mac, encourage the use of credit scores because they provide a consistent way to compare files. Although a specific credit score alone does not guarantee approval or denial, it is a major factor in loan decisions, interest rate pricing, and mortgage insurance costs. Loan commitment and closing the mortgage. Once the lender has reviewed the borrower's qualifications, analyzed the property, and verified that the loan structure complies with applicable rules, it may decide to offer the loan. The written promise to lend under specific terms is called the loan commitment. Several common types of commitments are used in practice. A firm commitment is a straightforward offer to make a particular loan at a specified interest rate, term, and amount, assuming the borrower completes the remaining steps and no new adverse information appears. This is the kind of commitment most homebuyers receive. A lock-in commitment offers the same sort of promise, but emphasizes that the interest rate is locked for a limited time, such as 30 or 60 days. During this period, the lender agrees not to raise the rate, even if market rates rise. The borrower may pay points or a fee in exchange for the lock, but gains predictability while the loan moves toward closing. A conditional commitment offers to fund the loan if certain conditions are satisfied. This is common in construction or development loans, where the lender may require completion of a construction phase, proof of pre-leased space, or other milestones. A takeout commitment is a promise by one lender to provide a long-term permanent loan that will pay off a short-term loan, such as a construction loan. When the project is complete, the permanent financing takes out the initial loan. Closing of the mortgage loan typically occurs at the same time as the closing of the real estate transaction. By that point, the lender has already sent funds or made them available to the closing or escrow agent with instructions on how to disperse them. The borrower brings any required cash to close, signs the final loan documents and disclosures, and receives copies of everything. The deed is recorded to transfer title to the borrower, and the mortgage or deed of trust is recorded to secure the lender's interest. At that moment, all of the qualification work becomes a real, enforceable loan. Review summary. In this section, you learned that qualifying for a mortgage loan is more than a simple yes or no decision. It is a structured process that blends the nature of the mortgage itself with a detailed evaluation of the borrower's finances, the property's value, and the legal framework governing fair lending. You revisited the core mortgage components of principal, interest, taxes, insurance, term, escrow, and mortgage insurance, and you saw how they combine into the monthly payment that borrowers must be able to afford. You then explored the legal and regulatory environment, including the Equal Credit Opportunity Act, ability to repay rules, and the concept of qualified mortgages. These protections require lenders to evaluate applicants fairly, explain adverse decisions, and design loan products that borrowers can reasonably repay. You saw how appraisals and valuations must be shared with applicants, and how high-cost loans trigger additional disclosures and counseling. On the practical side, you learned how lenders use income ratios and debt ratios to evaluate whether housing and total debt obligations are reasonable relative to gross income. You saw how income stability, cash resources, and net worth provide context for those ratios, and how credit reports and credit scores shape the lender's view of risk. Finally, you learned how all of this evaluation culminates in a loan commitment, and ultimately, a closed mortgage loan tied to the real estate closing. For a real estate salesperson, this knowledge is essential. It allows you to help buyers set realistic expectations, recognize when a loan might be stretching their capacity, and coordinate the timing of loan approval and closing with the negotiation and contract process. Discussion. Question 1. Why is it important for buyers to understand that their monthly mortgage payment includes more than just principal and interest? Answer. Because the total payment often includes property taxes, homeowners insurance, and possibly mortgage insurance. Buyers need to know that the number they must afford is the full payment, not just the loan amount divided by a simple interest formula. Ignoring taxes and insurance can lead to underestimating the true cost of ownership and could result in payment shock when the first bill arrives. Question 2. How do legal rules, such as ECOA and the ability to repay standards, affect the way lenders qualify borrowers? Answer. These rules require lenders to focus on legitimate financial factors rather than personal characteristics, and to make a reasonable determination that the borrower can repay the loan. As a result, lenders must thoroughly document income, debts, and property value, and avoid relying on temporary teaser rates or overly aggressive assumptions. The outcome is a system that, while sometimes frustrating for borrowers, is designed to promote fair treatment and long-term sustainability. Question 3. In what ways can understanding income and debt ratios help you guide clients in setting a realistic price range for their home search? Answer. If you know that most lenders will limit housing expenses and total debt to certain percentages of gross income, You can roughly estimate the maximum payment a client is likely to qualify for. From there, you can work backward to a likely price range, accounting for taxes, insurance, and association dues. This helps prevent clients from falling in love with homes that are far beyond what the lender will approve. Question 4. How does the loan commitment bridge the gap between underwriting and closing? And why is this stage important for you to track as an agent? Answer. The loan commitment is the lender's written promise to fund the loan under specific terms, provided certain conditions are satisfied. It signals that the file has passed underwriting and is moving toward closing. As an agent, tracking the issuance and conditions of the commitment helps you anticipate timing, address any remaining issues, and reassure the other party to the transaction that financing is on track. Closing remarks. Qualifying for a mortgage loan may feel mysterious to many buyers, but as you have seen, it follows a clear logic. Lenders evaluate whether the borrower can realistically afford the payment, whether the property provides adequate collateral, and whether the loan structure complies with modern consumer protection rules. They do this through documentation, ratios, appraisals, and legal standards that aim to balance opportunity with safety. Your role in today's real estate market is not to replace the lender, but to translate. You help clients understand what a mortgage is, why the lender asks the questions it does, and how their financial picture shapes the options available to them. When you can connect loan qualification to earlier concepts like market value, loan to value, and appraisal, you offer a complete and coherent picture of the home financing process. This not only builds your professional credibility, it directly contributes to smoother transactions and better long-term outcomes for your buyers and sellers.